unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer: policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy rate now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee does. But so that's you know, that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and you know, that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So I mean, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, you know, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, you know, low mortgages. In terms of banks, the banking system has been, you know, solid, strong, well-capitalized, lending. You know, we've seen good performance by the banks. We had the turmoil early last year, but, you know, banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, you know, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, you know, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, you know, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, you know, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and you know we've taken some signal from that. But you know, and of course, housing services, you're continuing to see high readings there. To some extent, that's you know, catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, you know, I would say above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, you know, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. You know, really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading it's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we've found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2% which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done, ultimately to get inflation under control, because those people experience inflation very directly, very painfully. And once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's the whole. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the markets should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral to try confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So.
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
The chairman of the Federal Reserve, Jerome Powell, wrapping up the June Fed decision. No change at the Federal Reserve to interest rates, plenty of changes in the forecast. Inflation moving up a little bit, the dot plot moving down a little bit. Equity markets just about holding on to gains and still near all-time highs on the S&P 500. On the NASDAQ, we're still higher by 1.8%, the Russell up by 2.2%. If you turn the page and switch to the board and get to the bond market, this is where things start to get interesting. Yields were down by double digits at the front end throughout most of the morning and into the afternoon. We're now down by only 9 on a 2-year at 474.55. And if you take an intraday chart of the 2-year yield, this shows the story of the morning and the afternoon perfectly. I want to show you 3 moves. The first move was 8:30 Eastern time this morning when CPI came out cooler than expected. What you see on yields? Drop. Easy to see. On the far right side of the chart, 2 moves I want to point out. One's at 2 p.m. Another is in the news conference. At 2 p.m., we had some forecasts. The dot plot came out, and we all wanted to know where the median dot would be. In March, it signaled, or at least implied, 3 cuts for 2024. That came down to 1. Yields started to climb. And then we all had a big question going into the news conference. Well, hang on a minute. Did they factor in the inflation report that came out this morning? And obviously, inevitably, Chairman Powell was asked about it. This is what he had to say.
What's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on. But the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes.
And it didn't look like many people made any changes, Lisa. And for that reason, that's why you see that spike higher, that little move higher, again on a 2-year yield. Cue the confusion around the forecast.
Well, is this by design in some levels? Basically, there were a number of Fed officials who got that CPI print and opted not to change their inflation forecast. Did they do so because they want more than 3 inflation reads to really gain confidence in some sort of disinflationary trend? Is it because, all things being equal, it's better to send a hawkish signal to markets that are eagerly looking for any opening to buy into any idea of a rate cut? All we know is that was a slight disappointment that's being reflected in slightly higher yields that have taken back about 5 basis points from earlier this morning.
There's always going to be a big conversation about where the median dot is. But when these numbers came out, you were the first to point this out. The split amongst the policymakers elsewhere. TK, just to go through this again, for those of you just joining us, this is what we saw. Get away from the median. On the committee right now, the dot plot shows 4 policymakers who saw no cuts this year. Some anticipated just 1 reduction, that was 7, and 8 expected, Tom, 2 cuts. The Federal Reserve is kind of all over the place.
Yeah, they're bifurcated. And what's important here is the dispersion is not smooth. It's like basically 2 camps. I thought Lub Kawa, of all people, had a wonderful tweet out on this, really pointing out the polarity that we see in the Fed as we stagger through the summer.
Kathy Jones and Charles Schwab is with us now to weigh in on some of what we heard in the news conference and what we saw in the release at 2 p.m. Eastern Time. Kathy, your thoughts on this one, please. I think we've got a problem with her microphone. Hopefully we can address that. Kathy, we'll come back to you in just a moment. I want to pick up on the labour market and talk a little bit about that. So on Friday, payrolls came in and it looked really hot. On the headline number, 272. But there's 2 surveys that go into payrolls. There's the establishment survey, payrolls. There's the household survey. That's the unemployment rate. Unemployment came up to about 4%. We all wanted to know what weight would Chairman Powell put on the headline figure and how much weight would he put on the household survey. And he kind of said something like this. Sometimes it's difficult to reconcile the differences. Payrolls might be a little bit overstated. Makes more sense to look at things over the last 6 months or so, Lisa. Overall, the picture is strong, and we've got a gradually cooling labour market.
People really honed in on the idea that the payroll jobs growth may be overstated. That line caught a lot of people's attention at a time where he reflected the confusion that we all felt, which is the reason why some people said, we don't believe these numbers, we'll wait for the revisions. Nonetheless, this is why he's talking about a series of data points, and maybe is part of the reason why they aren't having much conviction, because this is just sheer confusion that we're feeling from the Fed.
Do you remember when Diane Swonk used to talk about aspirational forecasts of the
Yes.
Federal Reserve? Let's have a look at unemployment together. 4% on Friday. This is where they see it year end. Median projection, 4% year end 24, 4.2% year end 25. Lisa, year end 2026, 4.1%. Now, I understand the Federal Reserve has a great influence on things. They can shape the events they anticipate. If they start to signal that unemployment's going to 5%, we've got a problem. And I think you see the market freak out. But to signal, based on your own projections, that we finish basically flat from where we are on unemployment by year end and climb to 4.2 by 2025, is that aspirational or realistic?
You know, we said a lot of their projections were aspirational a year or 2 years ago, and yet they were correct. So I'm humbled to sit here and say that they're just purely aspirational, and we have not seen the unemployment rate climb to such a significant degree, and they've actually had to decrease their expectation for unemployment rates just simply because the labor market was stronger than they expected. Now, I would argue that the idea of upgrading their expectation for inflation and keeping the same number of cuts, just pushing them back to a later time, raises some questions. And this was asked at the press conference. How do they accept that, given that they don't see the labor market breaking and that they want to get back down to 2%? How do we thread that needle? And that's a good question that I didn't really hear an answer to.
Mike McKee's run out of the news conference and got in front of the camera for us. Mike, let's catch up with you. Chairman Powell, did he manage to square the circle in that news conference?
Not really. John, I was thinking during this of a line from the old movie Blazing Saddles where the preacher says, "You're on your own, boys," because there doesn't seem to be any kind of direction here from the Fed about which way they're going to go and when. They're still their base case, as I mentioned in my question to the chairman, is that they're going to cut rates this year, but they don't see any difference at the end of the year between the economy now and the economy then. So how are investors supposed to anticipate what the Fed's going to do if the Fed doesn't know and can't give you any guideposts? The chairman said, well, we need a couple more reports that show things improving. But what is improvement? Last month, we saw the CPI change by about 1/10 of a point, and the PCE changed by about 1/10 of a point, and Chris Waller said, well, that's not good enough. I give those reports a C+. So it's really hard to tell what's going to move them. Obviously, he's sort of signaling not July, but from September on, it's an open question.
Mike, they want the convenience of a dramatic ex post decision. Maybe that's not the way the script goes this time. What will you watch in the data that allows them to get out front as they've never done before? Well, maybe the 90s, but basically that they've never done before.
Well, basically, you want to see what they want to see, an improvement in inflation data, but how much is going to be the tricky part. We'll have to watch both what the market reaction is and what the data show, and then what they say in their speeches. At the same time, we will also be looking at the unemployment rate and job creation to make sure things don't go south there. Either one might push them one direction or another. I think that at this point, they're going to be as cautious as possible, but they do seem determined to get at least one cut in.
Mike, a lot of people were asking, including both Mohammed and Bob Michael, whether the Fed officials really understood the CPI data and kept their projections. We got kind of an answer, but Seema Shah put it this way. You know, if they did know that, maybe that implies that they need more than 3 months of softer inflation prints before they can be convinced to cut rates. Do we have any clear message from the idea that, yes, Fed officials had the information, and yes, they had the chance to change their forecasts, and no, they did not do it?
Well, the chairman suggested that some people may have changed their forecast, but the majority didn't. It's not going to be extending the number of inflation data that they get. It's going to be more of the same that we saw today. It doesn't have to be maybe the same magnitude, but it has to be a continued sequence of slowing inflation for them to gain confidence. That's their magic word, is confidence, and they don't tell us what would give them confidence, but it seems like several more, 1 or 2 more maybe, would give them the confidence that they could start moving towards cutting rates.
Mike, you're expert at the data far more than I am. If you look at domestic final sales, take out the noise of trade, the world's agony, et cetera. If you look at domestic final sales, what's the run rate on the economy that they're going to be dealing with to July 31, September 18th, and near the election, November 7th?
Well, we were still in that area, Tom, 2.8% in the first quarter, still well above trend growth for that. And the Atlanta Fed GDP now is running above 3%. If you take that one and you take the first quarter GDP and average them, you're at 2.2% for the first half. So they're going to be dealing with, and they predict they're going to be dealing with, an economy that doesn't slow down at this point and doesn't affect the labor market at this point. And the interesting thing is they see core PCE inflation going up, but they're still talking about raising rates, or cutting rates rather. So it's a situation that kind of leaves everybody at sea here as to what it is they're actually going to do. If they wanted to advertise, listen to our speeches, this is a good advertisement for that.
Yeah, Mike, I'm not sure if that one bites. Let's see if that works. Mike McKee, thank you, sir. Great work, as always, in the news conference once again. This is the calendar for the next month or so. So July 5th, you get another jobs report. Let's see if it looks like the one we got on Friday. July 11th, you'll get a CPI report. Back end of July, very last day of the month, July 31, another Federal Reserve decision. No questions really about July, Lisa, but I guess it was implied based on the forecast we got a little bit earlier.
Basically, it seems like July is squarely off the table. It was not even a consideration. September, though, Jay Powell didn't even entertain that idea. He kind of hemmed and hawed. I don't want to talk about time frames. We don't want to be like, squared in,
I'm
given
sure
the fact
Powell would
we want
love
to be
this
flexible.
impression of him.
Well, I mean, honestly, that was exactly what he needed to do, right? Wasn't that kind of the goal that Bob Michael set out for him, was to do nothing? I mean, if anything, he had the most hawkish message relative to market expectations in a long time. So it was somewhat of a different Jay Powell than we've gotten in the past. But, he wouldn't really solidify anything. And that, I think, was by design, given their confusion.
I think emphasis really matters in news conferences, of course. It matters. It's pretty straightforward. It's where he didn't put the emphasis. He didn't really put much emphasis on the forecast for economic growth, unemployment, or inflation. Where he actually put emphasis was on the destination for the Fed dots. And I thought it was pretty interesting. So we were all sort of geared up to focus on 2024. Would the dot plot, the median dot, come down from 3 to 2, maybe to 1? It comes down to 1. But then you're looking out to 2025, and they give you one back. So they take 2 away and then throw an extra 1 in 2025. So really today, when you look at the dot plot, the ultimate destination, what's changed for the FOMC just in terms of the path for rates from here?
Basically, just the disinflationary trend is happening more slowly than they previously thought, but that at some point they will have this same trajectory just on a delayed time frame. And that was essentially what Jay Powell laid out today. And maybe on the margins, that's a bit more hawkish than the 2-year was pricing in before.
I'm going to go to modest further progress. Modest is on the y-axis. I have no idea what it means. Further in progress, John, is exactly what you were talking about, which is what they're doing here is they're extending out the optionality of their timeline, their x-axis. Because to your point, Lisa, this disinflation, it is slower. David Rosenberg, not the next Rosenberg, David Rosenberg says eureka, but what they did today was extend out the x-axis with further progress. That's not in any textbooks. That's marketing baloney as far as I'm concerned.
We can get to Jeff Rosenberg right now at BlackRock. Jeff, wonderful to catch up with you, sir. Let's get into it. What did you make of these forecasts, and can you square the circle for us?
I agree with Lisa. It's a little bit hard to square the circle here from the press conference. I mean, obviously, the morning's data set the tone for a very dovish press conference, and the one hike median kind of took the wind out of the sails, and so Powell was kind of faced with that as the backdrop, and so it was maybe a little bit less of the dovish Powell than we've seen in the past. But I think he did give us a couple of insights. One, he did talk about the overstatement argument on payrolls, a little bit to last week's data. Two, he talked about 2.6, 2.7 as being, I can't remember exactly the quote, a fine place to be. And I think that does reveal that this is a Fed that doesn't have to get to 2% anytime soon. And that's part of this asymmetric response function. If inflation is a little bit too hot, then we'll just hold pat. And if there's weakening in the labor markets or any kind of unexpected weakening, then we're going to cut and will cut more aggressively. And so I think they're comfortable with this path of inflation. And then I think on the third point, there's just a bit of confusion about how stale are the SEP forecasts relative to the new information from the morning. I think what is clear here is that having been a little bit burned by the enthusiasm at the end of last year and then the reversal on inflation, they're not going to want to reverse so quickly with just one good print. And he stated again and again they'll need more than just one, and I think that's why you had maybe the hesitancy. But understand that the difference between 2-cut and 1-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing. I think the broader theme here is this is still a Fed that is looking to cut rates, very supportive to financial markets. Obviously, the data this morning is supportive to that. A little bit dismissive about the strength of the labor market, so I think this is a pretty good setup here for bonds and stocks.
Does this mean, in your view, that September is still very much on the table, even if Fed Chair Powell really demurred when it came to a time frame?
I do think it is, and I think obviously, this is the volatility that is what happens when the data lights the way, when you're completely abandoning forecast-based policy for data dependence. But if we do get in the interim period between now and September, reports that are along the lines, we don't have to get as big of a downside surprise as inflation as we've seen, but that continued gradual rebalancing of the labor market, stabilization to slowing on the inflation side, then I think absolutely September is in play, as well as December and the 2 cuts that are, not in the median, but I think are still very much in play here.
Jeff, when he stepped off the stage, we were up 2.8 standard deviations on both SPX and NASDAQ 100. We've pulled back a little bit from there, selling into the excitement tomorrow morning, I guess. Jeff Rosenberg, simple. How do you invest in this? Do you just clip a coupon? Do you increase your cash level in this uncertainty? Is there an opportunity?
Well, I think, as I mentioned, the opportunity here is that this is a Fed that is very asymmetric, and they're asymmetric with regards to holding policy flat in the face of disappointing data in terms of strength or policy progress on inflation, and then very supportive on unexpected weakening in the labor market. I think that's very supportive to financial market conditions. I think there's a longer run, problem with that potentially, but in the short run, this is a little bit more favorable to risk markets and to risk taking. You can step out of cash into that front end of the curve. This is a Fed that's telling you that they're going to cut rates. So cash has been very supportive because they've held rates up, but the path going forward, and Jonathan mentioned it, this is just shifting the cuts into 2025. So you're going to lose the income by hanging out in cash. The belly of the curve for fixed income investors, the front belly of the curve, 2 to 5 year part. I think that's a very attractive part of the curve. I do think you have to start moving out into that part of the curve to lock in those rates. And the economy, to the comments on Mike McKee, GDP Now, the forecasting, above trend growth relative to the fears of recession. This is a very supportive market environment for credit. That's a carry argument. I think you can clip coupon there, take some risk there because the default risk is still very much low because the growth side of the economy is very strong.
Jeff, stay close. I'll get you back in just a moment. I want to talk about 25 by talking about 24. There's 4 meetings left this year. July 31, September 18, November 7th, December 18th. I want to go to the November meeting. November 5th, there's an election. The day after, they kick off a Fed meeting. Michael McKee, we're all talking about forecasts for 2025. None of us have got a clue, have we, about what 2025 is going to look like?
Well, you take a look at the dot plot for 2025 and compared to 2024, it's very, very spread out. There is no consensus at all. We pick a median for convenience and talk about it, and we say, okay, they're putting us up for 4 rate cuts next year. But really what the dot plot is telling you is they have no idea. And one of the reasons is we could have a completely different fiscal policy next year. And we have a lot of issues, including debt ceiling, the government funding, and the tax cut cuts that are going to expire that could change the economic picture tremendously. So I'm not going to tell Jeff Rosenberg how to trade that, but I don't think you can have a whole lot of confidence that what they're predicting today is going to be anything like what we'll be seeing at the November meeting.
And Mike McKee, thank you, sir. Of course, the forecasts are always more instructive to really gauge the reaction function. That's what's important here, how they respond to incoming information. But let's just run with this. The forecast for 2025. Bramo, what are they worth, given how much could change in November onwards?
Well, this is the reason why Bob Michael said, I'm in charge here. I'm a bond market investor, and I'm the person who sets the rates right now, not the Federal Reserve at a time where they are just as confused as ever before. I am curious, Jeff, what is your take on that? That right now we see big bond investors saying we're setting rates. The Fed is a bunch of confused people who are looking at the same data and equally confused as everybody else. We can look at supply and demand. We can react to all of the economic data. Sure, yields jump up and down, but we're the ones that are kind of the main guy in the room.
I'm going to agree with Bob Michael very much so, especially when we're talking about the back end maturities and the term premium. This is a Fed that's going to get less into the business of setting term premium, influencing the maturity of rates, and the difference between demand and supply, particularly as Mike McKee was just mentioning, we're going to have a big issue around fiscal deficits and their financing, and much more of that is going to be borne by us, the bond market investors, the private sector. So a lot more of that term premium, and then resetting that term premium is going to be dictated by financial markets. It's partly why I think the front end of the curve is a bit more attractive, because the term premium, you're going into that uncertainty with relatively low, yes, we're off the historical lows, but relatively low compensation for both term and inflation premium. I think that makes the back end a lot more challenging, and because we view it as more challenging, there's less demand, you're going to have more supply. I think that could be a factor towards a little bit longer run process of steepening out both term and inflation premium in the back end.
Jeff, what's important here, and you said it, that there's a risk-on feel to this, and certainly we've seen it in technology, and SPX, before he ended his press conference, up well over 2.8 standard deviations. Is the answer here, Jeff, that everything is just plain solid? There isn't the polarity of a boom economy or doom and gloom. It's just a solid American economy?
It's pretty solid, Tom. I mean, when you look at that domestic demand component, and it's so solid that, last Friday when I was on, we talked about the question that was asked a bit today, how restrictive is policy? Really, you're not really seeing it in the economic slowdown that you'd otherwise expect outside of the interest rate sensitive sectors. So for risky assets and for credit, as I just mentioned, I think that's a good thing. So I do think that the strength of the economy here helps to underwrite some risk-taking in a broad sense, and there's a bit of a worry there that may be leading to maybe less progress on inflation. But I think what we heard from the chairman today, they don't need, yes, they're going to say we want to maintain policy and get back to 2%, but it could be a long period of willingness to accept 2.5% to 3% as good enough. Take the win. We've come from 7 down to below 3. That's a good outcome, and not risk the economic growth side by over-tightening.
Jeff, love doing this with you. Thank you, sir. Jeff Rosenberg there of BlackRock, wrapping up Fed Decision Day and CPI morning as well. Let's get some final words around the table. TK, first to you. Final thoughts.
It's going to be eventful through the rest of the year. I thought it was off of CPI this morning, just spectacular. Yes, they're data dependent, but you know what? It's going to be eventful right up to Jackson Hole and beyond.
Anyone who is looking for some sort of certainty in the bond market, some sort of stability, good luck. Because right now you have a green light to go crazy, to see bonkers types of moves, to quote one of our guests earlier this week. Because right now there is no central planning when it comes to where rates are going. And that to me is significant at a time where at one point that was considered a financial stability risk. Right now, it doesn't seem to be. I don't know if that's a sign of strength or fragility, but right now, that is the takeaway. These double-digit moves in yield on a daily basis, they seem to be here to stay.
Well, right now, we're giving some of that up.
Correct.
Just recap some of the price action. Session highs on the S&P 500. About 20 minutes ago, we were higher by more than 1.3%, now positive by about 0.7% on the S&P. In the bond market, at the lows on a 2-year yield, we were down 16 basis points. We're now down about 7 or 8. So some of this unwinding just a little bit. The team's going to take over from here. They'll run you through the close. They'll catch up with former Fed Governor Betsy Duke and Jim Chanos. Look out for those conversations. From New York City, that's it for us. We'll see you at the end of July. We're all away until then. From New York, this was The Fed Decides.
It's 3:45 on Wall Street. We do check markets all day long here at Bloomberg. We've got 15 minutes to go ahead of the closing bell. U.S. stocks trading mixed. We did hit records as the Fed did little to alter Wall Street's bets that interest rates will drop at least twice this year, even as the central bank's more conservative outlook. Here's Fed Chair Jay Powell in his statement at the news conference.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures.
Dow Jones Industrial Average now down 101 points, giving up earlier gains. The S&P off-session highs still holding above 5,400, 54.15 right now, an advance of 0.7%. NASDAQ, the composite index, up 1.4%. Russell 2000 up by 1.5%. 10-year, 4.32%. The 2-year, 4.76%. Spot gold, little changed, up under 0.1%, 23.18 the ounce. And crude oil, West Texas Intermediate crude, up 0.5%, 78.28 a barrel. Bottom line here, earlier gains fading, but the S&P 500 did top 5,400 for the first time. Apple at a record up 3.4%. Also, Oracle after earnings at a record up 13.6%. After the bell, we hear from Broadcom. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. This is Bloomberg Business Week. Carol Masser along with Tim Stenivek, live on radio, YouTube, and Bloomberg Originals. We're just about, 20 minutes away? Well, actually, 12 minutes away. Time flies when you're having fun on a Fed Wednesday.
Fed Wednesday, already 3:48. Look at that.
Yeah, we're just moments away from the closing bell. Having said that, we did see stocks hitting all-time highs, Tim, before the Fed decision, holding on to those record gains. The S&P 500, in fact, topping 5,400 for the first time, marking the 20-month anniversary of the bull market. But Treasuries, they did pair some gains, and we've seen yields kind of move up a little bit off of that morning CPI print.
Yes, we just heard from Charlie Pellet. Mixed trade now. The Dow is down about 0.1%. The NASDAQ composite, though, up 1.5%. So let's get some thoughts on both the equity market and the bond market. We're joined for our drive to the close with Sylvia Jablonski, CEO and Chief Investment Officer over at Defiance ETFs. She joins us from New York City, also with us for the bond side.
We love this. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey joining us from New Jersey. All right, Ira, I want to kick it off with you. The decision, the rate market reaction. Walk us through the day, what happened with CPI, and then what we got from the Fed and what really stands out for you in terms of the fundamentally kind of backdrop on inflation and Fed think, and then how investors are perceiving it and traders are.
You're asking me for a whole dissertation here.
Sorry.
But that's
defend away. Defend away.
All day to prepare, Ira.
That's right.
So for CPI, obviously the better than expected CPI number, I think, gave a lot of people relief, particularly in the bond market. And you saw a big rally in all across the yield curve. So you had 2-year yields and 10-year yields both lower by about 15 basis points at one point. And we kind of hovered there until we got the summary of economic projections, because the statement didn't really change. I mean, there was basically one word of any significance that changed there. But the summary of economic projections, I think, surprised some people in the rate market, with only one cut now being the median dot this year, and 4 members who think that the Fed's not going to do anything this year, that they're going to remain on hold. So, a little bit more hawkish there, sold off a little bit. Then Jay Powell starts to talk half an hour later, and we wound up with him being a little bit more hawkish. In fact, we have a natural language processing model that parses all the words, and we looked at his opening remarks this morning for this afternoon. Seems like this morning, the last 2 hours, this has been absolutely crazy. But he was a little bit more hawkish than he was in May, and then the market sold off a little bit more. So now we've given back about half of the gains in the bond market that we made after the CPI report. And I think that, traders are still trying to figure out, is the Fed actually going to cut? And if so, when and how much? That really affects the 2-year note. The longer end, what we saw was basically the Fed pushing out their more rate cuts into 2026 now, because you have 2 less cuts this year than was in the dots, the same number of cuts next year, but then the terminal rate for 2026 is exactly the same. So basically, for the long end of the curve, if people think that the dots are going to be realized, which they don't, right? No one actually thinks that what the Fed says is actually going to happen. They're going to, yeah, exactly. They had to at least take some profits before the end of the day.
You passed the oral examination for your dissertation. You are now Dr. Jersey. All right, let's get to Sylvia Jablonski and get her view on this. Break it down for us in terms of what we got from Jay Powell and company and what that means in terms of the investing environment, Sylvia.
Hi, Carol. Great to be here with you today. Yeah, tough to follow the lead on that dissertation there today. But, I think that in terms of what happened today, it's pretty much what the market expected, right? We didn't necessarily get a cut today. It's good news that CPI data is cooling off. It looks like inflation is trending downwards, and this is really what the market wants to hear. I actually think that we're in the sweet spot now where equities are going to kind of continue to rally because we do have rate cuts coming. Maybe we don't get as many as we thought this year. Maybe it gets pushed off, but we're just talking a couple of months here. So rate cuts are coming eventually. And this is kind of, stocks really performing on this news. And so I think overall it's good for the markets. This feels a little bit like a soft landing. You have inflation coming down, jobs numbers are, maybe a little bit hotter than they should be, but certainly, stable. Wages are stable. Economic growth slowed, but more or less in line with expectations. Corporate earnings are good. I think we're in a good spot in the market, and today doesn't change a whole lot, but it's a great data point.
Quick question to both of you. First to you, Sylvia, just quickly. I don't think I was listening to all of it, taking lots of notes, but did I miss anything? Did I hear anything about a rate increase?
No talks of rate hikes.
Ira's also shaking his head. I can see him. He's shaking his head saying no.
Well, Ira's, that's
you passed the test too for doing a good job listening today, Carol.
Tim and I are kind of glued. Like we run to makeup, we run to the bathroom, like we've got our earbuds in, like everything, because we want to hear all of it and the tone. But Ira, is that significant that we didn't hear anything? Sorry, Tim.
Went there.
The great reveal of what happens behind the scenes.
Just so you guys know, they actually play Bloomberg Radio in the bathrooms here at Bloomberg News. So. In the whole building, so
it's amazing that people come out like that was a great interview.
Yeah.
Ira, having said that, significant that we didn't hear anything about a rate increase, and again, they're data dependent, so it could change.
Yeah, the chances of it changing, I think, is pretty low because, Jay Powell has been very reluctant, even when directly asked at the May meeting whether or not a rate hike was possible. He basically said no. He said at this point, based on all of their forecasts and everything else, they're much more likely to remain on hold than they would be to cut rates. So it is a bit asymmetric, right?
I mean, to raise rates. More likely to be on hold than raise rates.
Yeah, correct. To be on hold than raise rates. So basically, they're going to be on hold if inflation increases significantly, and then cut rates if the economy starts to deteriorate further or if inflation keeps coming down. And it's that asymmetry that's keeping the yield curve inverted and will likely continue to keep the yield curve inverted until they actually start to cut interest rates. And I think that's, someone pointed out to me today, one of our customers was like, 2 years to today is when the 2s10s curve first inverted. And so we're at basically the longest period of yield curve inversion ever, and that's likely to persist, I think, until close to the end of the year. The other thing that's come out of this in my quick discussions with customers after Jay Powell spoke is there's a lot of people who think that a September cut is very possible. I don't think that's true at all. Maybe if they cut twice, but why cut in September? You're only going to get 2 more months of data points basically between July and September. So why bother? Why not wait until after the election? They moved the meeting of November. It's now going to be on a Thursday. So they avoid having a meeting on election day, and they can can cut rates then. And 6 weeks in the grand scheme of things, from the longer term thinking that you know, we're markets people, right? We think about what the market's doing every second. The Fed is thinking more longer term. So 6 weeks in the grand scheme doesn't really matter. So I think that they would hold off until then. They could still cut twice this year. That's completely possible if the economy's falling out of bed. But you know, we're unlikely to see that prior to Election Day, at least in my view.
Okay, Sylvia, I want to go to you and just get, you know, you have this thesis where things look pretty good. We're in the sweet spot for equities right now. I'm wondering what derails that thesis. Like, what data could you see over the next few months that says, wait a second, things are not going the way that we think they should be going?
Yeah, and look, that's certainly happened, right? We get these events out of left field that we don't expect, and they move markets. And so I think that those events remain the same. If inflation, for example, were to suddenly start increasing or just, you know, doesn't budge for long periods of time, I think that, you know, kind of challenges my narrative. The other thing is, of course, geopolitics. This is, you know, over the last few years, it's the first time where we have two very active, you know, global wars going on that are, you know, ticking time bomb, could be ticking time bombs at any moment. And I think that that's something that we always have to think about. China and Taiwan, what happens during the election, tariffs, things like this. So I think it's any of these kind of, you know, unexpected events that have to do with geopolitics and politics, I'll say. I don't think inflation is going to be the thing, to be honest. I think it's something like that.
We are data dependent too. We kind of move from data point to data point to Fed speak to Fed speak. Just got about 40 seconds. Really quickly, Sylvia, 20 seconds for you. Your next focal point, just quickly.
Yeah, I mean, I'm still looking to build out the AI trade and look for those opportunities. So starting to expand it to things that AI will benefit, like healthcare, like the materials, uranium, copper, things like that. So looking for some new investment ideas around that theme.
10 seconds for you, Ira. Next focal point.
Yeah, it's all about the data. So it's retail sales and then the PCE data at the end of the month.
All right, so appreciate it. Dynamic duo. Both of you passed the oral examination. So really good stuff and great setup for us.
What time are the papers due? Tonight?
I don't know. Now you go celebrate, right? Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, and Sylvia Jablonski. She's CEO and Chief Investment Officer at Defiance ETFs, joining us in New York City. Folks, just got a few minutes left in the trade. We are heading to our TV colleagues. That's because the closing bell starts right now.
Here on Bloomberg, coming up in just a second. Don't go anywhere.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with Carol Massar and Tim Stenovic on this Fed day here. A big rally that we're seeing in the equity markets here. A big rally, believe it or not, in treasuries, leading to a big drop in yields here on this Wednesday afternoon.
Yeah, fascinating. You know, we were kind of all counting down to it. No surprise here. We just talked with Sylvia Jablonski over at Defiance ETFs, kind of saying a sweet spot for equities, a soft landing, like it almost feels too good to be true. You know, and I don't know, it's just kind of interesting to see the market reaction. Yeah, we came in a little bit on stocks and we saw yields kind of bounce off their lows, but nonetheless, investors seem to be taking it in stride.
Yeah, but that tone was set at 8:30 this morning with that CPI data that came in. That was exactly what the equity market and the bond market wanted to see, Scarlett. And that set the tone throughout the day today.
Yeah, that was the high water mark for trading volume as well. If you look at average value at time of shares traded, it was really in the morning and it picked up a little bit right when the FOMC announcement came out. But you didn't get the end of day pop that you typically see. I mean, it's certainly come back from the mid-afternoon, but most of the big news came at 8:30.
And this just goes to what Savita Subramanian said at Bank of America earlier on Bloomberg Television. Things are kind of awesome. It's a straight up Lego movie theme song. It's not totally awesome, but it's kind of awesome. And that's exactly what I feel like the theme was throughout Jay Powell's press conference. And that's sort of how the equity market seemed to react.
This kind of gets us back to that question. Is this really kind of that Goldilocks scenario, at least in the short term here? The market seems to be pricing that in here. And I do have to go back here. That a lot of this, what we're seeing in the market today, the gains that you're seeing on the screen there, a lot of this was priced in long before we got that Fed statement, long before Jay Powell took the stage. A CPI report really emboldening the bulls here on this Wednesday afternoon. The S&P 500 at a record 5420 and change right now as we wait for these numbers to settle. That's roughly about 46 points higher than where it was yesterday, 0.9% on the day. The NASDAQ composite up more than 200 points, or about 1.5%. The Dow is actually your laggard here on the day. It's going to finish the day in the red, but only by about 0.1%. And the Russell 2000, which has basically been leading the market for a good portion of the day, up on the day by 1.6%.
Can I just point out that the S&P 500 off that late December 2023 low is up almost 32%. So talk about the move to the upside. Having said that, in today's trade, I know Tim was having a hard time finding some of the decliners, but we had kind of an even split. If I look at the trade, it looks like 297 names in the S&P 500, Scarlett, to the upside, 205 showing some declines in the trade.
All right, let's show you how that plays out in terms of sector performances. You split the S&P 500 up into 11 industry groups. Because tech is the most heaviest weighted group, it's the biggest slice of the pie. That group up 2.5% thanks to Oracle. Industrials and consumer discretionary also gaining about 1%. On the downside, your laggards are energy stocks led by Valero, consumer staples, and utilities losing about 2/3%.
You have a cold.
A little bit.
Are you okay?
Oh, no, did I give you my plague?
No.
Oh, thank goodness. Okay.
COVID's going around, so I hear.
Please don't say that.
I know. All right, let's get to some of the individual gainers, if we may. Oracle, man, a standout. We were breaking it all down late yesterday after the closing bell here, on the closing bell, if you will. The stock up, as we said, more than 13%, hitting a record. Earnings last night reported better than expected bookings, announced partnerships, deals with tech rivals, so giving a boost to Larry Ellison's efforts to redefine the software maker as a major competitor in the business of cloud computing, but investors really buying into that one. Apple, again, continuing to build on yesterday's gain of more than 7%, another 2.9% to the upside, another record close, so back-to-back on that one. A top name in the NASDAQ 100, overtaking Microsoft in market cap. iPhone maker regaining its title as the world's largest stock amid growing optimism AI will spur a rebound in revenue growth. AI, anyone? Pretty exciting. Affirm, again, up 11% yesterday, up another nearly 6%. Related to Apple, that after the buy now, pay later company said its payment products were expected to be available to U.S. Apple Pay users this year. And I got to just mention Tesla, if I can. A lot going on. Stock up about 3.9%. Kathy Wood setting a new $2,600 price target for 2029. Stock closing at $177.
I'm sorry, for what year?
2029.
Okay.
Don't go there.
Okay. I kind of want to go there, but sure. We'll move on.
You'll go there in a robo-taxi, Romaine, whether you'd like to or not.
I'm going to mark this on my calendar right now.
Well, Mark,
little Google alert for
Mark, also tomorrow on your calendar, because you've got shareholders again, investors voting on that $56 billion pay package for Elon Musk. Over to you.
Okay, so it was just tough to find, full disclosure, decliners with a good story
really
today.
hard.
So bear with me here when I talk about Lululemon down 2.6%. It is in the S&P 500, not the worst performer on a percentage basis in the S&P 500, but kind of up there. They fell, shares that is, after Randall Koenig over at Jefferies said a recent visit to a UK store revealed ample discounting. It adds to the view that performance has peaked.
I've never seen that news.
I just bought something from Lululemon.
Well, nothing. Was it on sale?
No, I paid full price.
You know why?
And now I feel like I should return it.
No, you go to the UK.
You got
buy
to
from
fly
there.
to the UK.
Sure, why
You
not?
got to fly to the UK.
Yeah.
And go to the UK store.
Yeah.
And get the discount there.
Okay. Now, do they let me in?
Ample discounting, at least according to this Jefferies analyst. And I guess that's probably a reason why shares are lower, because there are never sales there. So there's a reason that he says investors should be a little bit concerned. He did say there was significant inventory outside of Lululemon's core colors,
They do
which
have a
suggests
sale
to
rack
him
that's
that
often like these
fashion
off weird
risk
things. Like,
remains
I'm just gonna put
elevated.
that out, but go ahead.
I have not been to a store in years. All right, Monster Beverage.
Wow, you're a man of the people,
We're all a
Tim.
little fed
You just have all your
today.
minions do your shopping for you.
I just order it all online. Yeah, I just ordered it all online.
You should see they just bring it to his desk every
Beverage
day.
theme for the remainder of my decliners. Monster Beverage down 2.7% today. It actually fell intraday to the lowest going back to October 24th. We saw Roth MKM analyst Sean McGowan reducing his price target from $59 to $56. It reflects the concern of slowing growth for its U.S. core energy drink sales, as reflected in recent Nielsen and Circana scan data, according to the analyst. Actually, a similar story over at Celsius. This was a recent decliner for me, down another day. Fell earlier in the session, more than 5%. 6%, ended up finishing the day lower by, what, more than 6%. This was its lowest intraday in months. Analysts reduced their estimate for the energy drink maker after it said at a conference on Tuesday that PepsiCo further reduced Celsius inventories. They are, of course, a distributor for Celsius.
I see your theme. I get it. You got
Thank
sports, you got the sports beverage, and then you got the energy drinks. I got you, Tim. I got you.
Thank
All
you,
right.
Alex.
Let's take a look at the bond market here. No surprise, you saw buying all across the curve. You have yields lower. Now, when CPI came out, we saw a big move lower in yields, a gap down by about 14 basis points on the front end, and then now we're kind of half round tripped back up to yields just down by about 7 basis points. But it's been a pretty monster rally for the bond market over the last few days.
Yeah, the big moves to the downside on those yields now, it raises the question here as to just how much of Fed easing the market will feel comfortable pricing in. And there's still a little bit of a disconnect between what we saw on the dot plots and what we're seeing right now, both in the bond and in the options market.
Yeah, not like we've never seen that before. All I would say is that we're going to get more data points. We're going to get Fed speak. And I do feel like, Scarlett, we're going to start seeing things kind of, jump around. We've heard this from our rates team here, that a lot of volatility. I mean, this is what we've seen in the rates market, and it's probably going to continue.
So now that they have one rate cut projection in the dot plot, are we in agreement here that September is the only logical choice? Because it can't be anything after November, right?
I'm not gaming that. I have no idea.
I mean, Ira did say that waiting until after the election and
yeah, because isn't the Fed meeting right after the election? Like
November
after
7th.
or something?
They moved it to Thursday as a result of the election.
Oh, it's a Thursday.
So it wouldn't actually fall on election day.
Okay.
But Ira Jersey just said to us, waiting 6 weeks after when they should actually do a rate cut in the greater scheme of things is not actually that big of a deal.
Yeah, particularly if it's just like a 25 basis points, right? I mean...
Well, I think then that goes to the point, do you get one, and then you get a bunch of them coming after in different meetings, or do you wait for a longer period of time, or do you do one and then you have a big gap? Like how that structure looks. The ECB is doing the one in a gap. What does the Fed wind up doing?
Assuming, too, we have an outcome on that November election. All right.
Yeah. So that was a great moment. That was a great silence.
Yeah,
like,
thanks, Carol. Thanks for going
like
so
that,
dark there. Yeah, sure, why not?
All right, so let's go to something. We can't really control all of this, but we can report on it. Something that we can kind of control is maybe something we want to get, for our dads that are out there or men in our lives. There's a new cologne. Apparently, it's a collaboration between Pepsi and Chef Bobby Flay. It's called Smoked. It's a combination, a scent combination of Pepsi, smoke, spice, caramel, citrus, and more. So
who asked for
smoky
this?
and flame-fired. You know you want this.
I mean, I kind of do, but still, I'm kind of disgusted by it as well.
Yucky.
Can I be disgusted and intrigued? Is that possible?
Yeah, do they have like the scent things where you can, put the scent thing in and like put it in the kitchen versus cologne? Like I don't want to.
Okay, there
I
you
feel
go.
like an air freshener. Someone.
Apparently, this is more of a Mother's Day gift for Alex than a
Like the
Father's Day
sticks.
gift.
You put a stick in the liquid and then it has the scent.
You want to put this on your body? You want to smell like Pepsi?
I don't. That's why I want to put it in like a air freshener thingy in the kitchen.
There's spice and caramel and citrus.
I was just reading the other day that Dr. Pepper actually overtook Pepsi.
I read that too, yeah.
Yeah, it's huge, right?
So is this Pepsi's last gasp here? I wouldn't mind smelling like Dr. Pepper.
Really?
Yeah,
You
or
are
Fanta.
one weird dude.
No.
No
to all of that.
I don't want to smell like any of this.
Yeah.
Can we go
Why
back
not?
to Lulu shopping?
Wait till tomorrow's show, Alex. I'm going to reek.
They're going to be sending us bottles as we speak. All right, guys, that is a wrap. Our cross-platform coverage, our Fed Day cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. We are live.
Is that Cola-Own that I smell?
Cola-Own.
Cola-Own. That's what it's called.
Cola-Own. I didn't go there.
You didn't go there.
Cola-Own. That is like
It's
so...
a good choice. I'm just going to say, kudos to you.
You know
It's a
you
good choice on discussion topic.
I'm thanking Tom Busby, like
Yeah.
our affiliates, because man, we overheard him in the newsroom, and we're like, Tom, what is that? What is that? So thank you, Tom. Thank you, Fed, because it definitely gave us some interesting stuff to talk about. We're going to stay with the Fed for a moment. Fed officials, as you know, penciling in just one interest rate cut this year, forecast more cuts for 2025, reinforcing policymakers' calls to keep borrowing costs higher for longer to suppress inflation. Fed Chair Jay Powell at today's press conference after the decision.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant, beginning to loosen policy at this time.
High for longer. That is Jay Powell.
I've heard that before.
Yep. It's not a new narrative.
He's not, I would say he's not full of surprises.
No, steady.
Which is probably what a Fed
markets-
chair should do, yeah, right?
Yeah, exactly. So I'm curious about how it impacts the investing environment. So let's get to that. Alexandra Brown is with us. She's Senior Managing Director, Chief Development Officer at the Family Office Wealth Manager, Lido Advisors. They have some $19 billion in assets under management. She joins us here in our Bloomberg Interactive Broker Studio. Ali, welcome, welcome, welcome. What, if anything, and I am curious about, we obsess, as you would expect, and as you just heard, about the Fed and what Jay Powell has to say, but it does move markets. So what about what we got in terms of the Fed decision, what he had to say about kind of color around the economy and the outlook, impacts kind of your world?
Oh, absolutely. It's everything that we do. But understanding and educating yourself is one piece.
Yeah.
Where were we 6 months ago? We projected 6, maybe 7 rate cuts.
Yeah.
We haven't had one, and yet the market's hitting new ultra highs. Right, so the question is, how do we, I think everyone's waiting for that first cut. When is that first cut going to be? I do think if we would have seen signs from the press conference of having a second cut this year, we might have seen stronger futures be producing now. But it absolutely plays a role, but I think where we are now, it's proceed with caution. And how do we proceed with caution? How do we build the portfolios to look like that? It's interesting because one would argue in the wealth management space, pre-inflation, it was a hard world to retire in. Right, when you exit the workforce and you move from the accumulation phase of your life to the withdrawal phase,
because you couldn't get out of the fixed income side of things. Well,
yeah, it was either you're in or you're out.
Yeah.
Either you're making money or you're making nothing.
But at the same time, stocks were up double digits year on year, with the exception of just a couple of years because of that low rate environment.
Exactly. Yet we raised rates substantially in 2022. The stock market soared in 23, is still soaring in 24. So how do we look at that?
I'm curious about your clients. They're high net worth individuals, family offices, family money, maybe passing on to generation. Where is it that they typically like to invest in your world? Because Tim and I spend a lot of time talking about increasingly family offices wanting to be in the private markets. But I'm curious about where a lot of your investors ultimately, invest, and they tend to park it then for a long time.
Sure, but it's also understanding there's so much similarities between the family office space and the retail space. Let's put it into perspective. You sell a business, and now you have $500 million, a lot of wealth, right? I have yet in my career to see a $500 million family have 60% in stocks, 40% in bonds, and rebalancing once a quarter. So
where are they?
Yeah, so what is their goal? Their goal is to build in control. How do I build in more control around outcomes like we're seeing today that we have zero control around? Whether it's building in alternatives within the portfolio, with real estate, right? It's amazing. You look at a real estate investor, they're typically very heavy in real estate and cash, right? Why? Because there's a lot more control in that aspect. So building in control, whether it be using alternatives, and there's ways to build in control in the liquid markets.
But drill down, where in alternatives do you find your folks wanting to put their money in this environment?
We like the alternatives. We work in all aspects. So whether it's we buy real estate, we lend on real estate, private equity, middle market lending has been the topic of every conversation lately, all the way up to hedge funds, right? Which is an interesting factor if you see the amount of money pouring into hedge funds now, because one is arguing, is that tactical, active, single stock management beneficial? Are you getting value there?
Right. What's a typical allocation to alternatives in a portfolio?
So it very much depends upon the client, what the client's seeking. I think the big thing that we look at on our end is the need for liquidity. What people don't realize is that you don't need 100% of your money liquid on a daily basis, especially when you look at building alternatives into tax-deferred accounts that have longer time frames. So it's all about the client, the need, the desire, where it's fitting from a tax perspective. I'll give you a quick example. A client that maybe has one of the long-age pensions, right, that's completely covering their income needs. Their portfolio can be a lot more aggressive and a lot less liquid than maybe someone who's needing to pull out of their portfolio on a consistent
So
basis.
they might have a higher concentration of alternatives because alternatives are less liquid.
Right, and they can play because they've already got something kind of as their safety net, if you will. Having said that, I am curious, among the wealth clients that you guys work with, what is it that they ask you about the most? Is it something like NVIDIA? Is it AI? Is it Fed policy? Is it the fixed income? Like, I'm just curious where they are like, wait a minute, is that an opportunity for me?
Listen, AI we can't ignore without question. It's just the way we're seeing it promote itself. I mean, look at this week, for example, with what happened with Apple, right?
So do you say get into Apple now?
I would say proceed with caution. It's all about, everything has a place within a portfolio. It's a matter of how much and where and understanding. So clients that come to me and say, I want private equity exposure because they heard about it at the golf course, right? You know, it's an education.
Which covers a lot.
Which covers a lot, and what sector and how liquid. And so there's a big education around the alternative space and what goes into that bucket.
How do you give clients exposure to private equity?
Yes, first of all, we need to educate them, right? They hear the word. Yeah.
Right, but I mean, you can get exposure to private equity by buying the stock of a publicly traded firm that is in private equity, but you can also go to an alternative asset manager, which a lot of wealth managers work with, and then buy into their funds as well. What do you guys do?
We do a combination of both. I would say more the latter. The private equity space that we do is in the private space. They're very opportunistic, though. And
so it's not like you're buying KKR, you're buying, no.
No, and it's opportunistic. We have a deal, the deal closes quickly, right? So it's a client that we're build, hey, listen, we're going to build an allocation for private equity, and this deal that may come around this week may work, and it may not, and we'll reevaluate when the next one comes around.
What do you say in terms of how you think it's smart for your clients to get exposure to AI? And these are folks that will park money for a while. So what is it?
I don't think we can ignore it. It's going to touch, AI is not just tech.
But how do you play it then? Or how do you suggest?
There's ways to get exposure to AI with controlled outcomes, right? Whether it's using a combination of options, saying, listen, I want to participate in this space.
Yeah.
I want to grow in this space, but I don't know if I necessarily want to take very directive risks. So I'd like to get exposure, but how do I build in protection? We do a lot of options in-house.
Like against a specific equity name,
I would say against, but very different. With, right? So options, I think, get a huge negative connotation in the market as the media.
And I didn't mean it like that, because there's two sides.
Yeah. No, absolutely. So is there a way that we can get exposure to a certain number of AI stocks, right, where we can participate if things go up, but have some protection if we're wrong, to avoid that timing component?
Speaking of AI, we are getting Broadcom earnings right now. Second quarter adjusted earnings per share beat estimates. We're seeing stock move higher in the after hours right now.
Up about 8%.
Wow, yeah, stock moving higher in the after hours. Sees fiscal year revenue approximately $51 billion, beating estimates of $50.6 billion.
Yeah, we'll be looking for some more color when it comes to certainly AI and chip.
20 seconds, do you use AI at your firm yet?
Yes, in different types of ways.
But were you using AI for years?
We are doing more and more. It's all educating ourselves and how to incorporate it effectively. You know, being in the finance world, we're so regulated. So as AI gets more regulated, I'm interested to see how it bleeds into finance.
Thank you. Really appreciate it. Allie Brown, she's Senior Managing Director and Chief Development Officer over at Lido Advisors, joining us here in our Bloomberg Interactive Brokers studio. More on Broadcom. That's coming your way in a moment.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Turned out to be a mixed finish today, a Fed Wednesday, CPI Wednesday. Briefly after the bell, we did hear from Broadcom, the chip designer. It reported adjusted EPS for the second quarter that beat the average analyst estimate. Shares ripping higher after ours. Broadcom, AVGO on the ticker, the old Avago, up now by 9%. Records today as the Fed did little to alter Wall Street's bets that interest rates will drop at least twice in 2024, even after the central bank's more conservative outlook. Here's Fed Chair Jay Powell at the news conference, who said he wants to see more friendly economic data.
We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading it's only one reading. You don't want to be too motivated by any single data point.
Fed Chair Jay Powell, you heard his remarks live on Bloomberg Radio. S&P up 45, a record closing above 5,400 for the first time ever, 5421, gain there of 0.85%. The Dow down 35, drop there of 0.1%. NASDAQ up 264, a gain of 1.5%. 10-year yield 4.32% with a 2-year 4.75%. Gold up 0.2%, 23.22 the ounce, and West Texas Intermediate crude up 0.6%, 78.40 for a barrel of WTI. Briefly, Apple at a record, up today by 2.9%. Also at a record after earnings, Oracle up 13.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Broadcom just out with earnings, Carol. Shares hitting an all-time high ahead of results, also rallying big time after market.
Up 9% right now.
Look at that.
Yeah.
This after an upbeat fiscal year revenue forecast. Let's get right on over to Kunjan Sabani, Bloomberg Intelligence Senior Semiconductor Analyst, joining us from our San Francisco bureau. Kunjan, I mean, a lot of the chatter ahead of these results said that, yes, the numbers would exceed expectations. Did they exceed even your expectations?
They did, and in fact, it seems like we don't have the segment details yet. They will be given in the call, but seems like they expected on the two fronts, which were the most important. One is on the AI side. It looks like the AI revenues beat what we thought it should be in the quarter, and the biggest beat seems to have come from the infrastructure solutions, which could be driven by better than expected VMware numbers, and maybe the non-VMware business, which was supposed to be weaker quarter over quarter, was not as weak as we expected.
Remind Kunjan, I always think about this when we speak with you or we talk with our Ian King, that not every chip company is the same. Remind everybody what Broadcom is all about, right? Because they're a chip supplier for Apple and some other big tech companies, but what type of chips they are specifically?
Well, they are almost like a conglomerate when it comes to chips. Like, look, for about 40 to 45% of their business is actually software. So you can't even call it a chip company, but they have a huge business with about 20%, 25% with Apple, which goes in the smartphone business. Now they have a growing business in networking, which is regular enterprise networking, all the connectivity chips in the data centers, but a big pie of that, which is supposed to be $10 billion this year, is the new AI revenues, which we will be looking forward to hearing. And then they have an industrial business, they have their regular storage business, they have an industrial business. So a lot of combination of a lot of business. But the key three biggest, largest are the wireless to Apple, the networking, and now the VMware with the software.
How safe is that Apple part of the business, given that increasingly Apple's looking to do a lot of its own chip development in-house? And we saw what happened with Qualcomm, too.
Yeah, out of all the chip suppliers to Apple, I think this, according to us, is the strongest relationship. So I would fear other companies losing out before I would start worrying about Broadcom, in short, getting out of Apple.
Okay.
You know, it's interesting, too. I mean, when you look at like different chip names, I mean, what is this a barometer for more broadly in the semiconductor industry, Kunjan?
Typically, because of the way they run their business, which is a 52-week long lead time, they seem to have less volatility, less sort of channel inventory buildup, and less sort of this whip kind of a demand. So it is generally a good indicator of long-term, an year out or more out, how the demand is looking. More and more, it has become an indicator of how the AI demand from the ASIC side is looking. So what I mean is how much are Google, Microsoft, Microsoft, Facebook, etc., all of these companies spending or going to spend in their own custom silicon programs, because Broadcom is one of the biggest supplier to the largest cloud providers in their ASIC businesses.
We're seeing second quarter revenue from AI products come in at $3.1 billion. How does that sort of gel, Kunjan, with how you're thinking about that part of the business?
Yeah, we did expect this to be in sort of in the 2.7 to 2.9-ish range, so definitely came above. One thing I would be very focused on is their full year guide only came above 500 million than what was on the street. It would have been, investors were hoping for a higher upside to their 10 billion AI revenue target for the full fiscal year, as well as some higher upside to the 12 billion VMware target. So at this point, I guess because the upside is only 500 million, I'm likely that both of these areas did not sort of hit it out of the park, but still an upside to the numbers we were expecting.
Hey, top of mind as we get ready for the analyst call with Broadcom, what are you going to be listening for? What would be your top question to the executives there?
Yeah, again, the three key areas would be more upside or engagements on the AI business, especially with Google's TPU 5 and 6 ramps expected in the future. More upside or clarity on the VMware integration and how the rest of the year looks like. We want to hear better or above that 12 billion number if possible. And just third, on the cyclical areas, the sort of non-sexy but still a decent percentage of their business, which is broadband, regular enterprise spending, server, industrial, if Q2 will mark the bottom or not, or if we expect continuous weakness into 3Q.
I hesitate even to go here because it's not about fundamentals, but the company also announced a 10-for-1 forward stock split this coming just the same week that we saw NVIDIA stock do a 10-for-1 split. Do you
and
care?
a quarterly
do you
stock
care
dividend
at all?
of $5.25 a share.
That part's important. But do you care at all about the stock split?
I mean, you would think in today's day you would not, but we saw the reaction NVIDIA got, right? And Broadcom is one of the other AI names here and doing the same thing. So definitely, I think some of the reaction could be driven by that 10-to-1 stock split.
Kunjan. Thank you so much. Kunjan Sabani, Bloomberg Intelligence Senior Semiconductor Analyst. We're going to let you get back to covering Broadcom because I know you got some reports to write.
Just a quick rehash. Shares of Broadcom up about 9.5% in the aftermarket. This as the company, its latest results and annual forecast topped estimates, out there on the street, lifted by robust demand for artificial intelligence products. So definitely some upbeat. So we'll look for some more commentary when the call begins.
Yeah, shares higher right now. Look at that, Carol.
Yeah.
Change from the open up 9% today. Change from previous regular session close 12%.
And that's building on a more than 30% gain, 30% gain here in 2024. All right, everybody, you might remember the Bloomberg Big Take last week. It was about the short sellers that were fearing extinction as stocks continue to go higher and higher. Short interest in typical member of the S&P 500 hovering around the lowest levels in more than 2 decades, according to Goldman Sachs. Well, now we've got a special interview on Bloomberg TV and radio. Jim Chanos, legendary short seller, president of Chanos and Company, talking with Romaine and Scarlett Fu. Over to Scarlett.
For years, the Federal Reserve's policy of lower rates for longer helped fuel a bull market in stocks. And even now, after the Fed's rate hike campaign to fight inflation, the bull market keeps on running. It's all raising questions about the future of short selling. So here now to share his perspective, I'm pleased to say, is legendary short seller Jim Chanos, president, managing partner, and founder of Chanos and Company. Jim, great to see you here in New York with us.
Thanks for having me.
You look at the number of short buys hedge funds as tracked by HFR, and it's fallen dramatically from 50-something to 14 now, 50-something in 2008 and 14 in about 2023, 2024. How much does the rate environment overall contribute to the shrinking universe of short-selling funds, do you think?
Well, I think the rate environment is probably the first or second derivative. I mean, it's really the ongoing persistence of the bull market, which has now been 15 years. And we saw something similar, Scarlett, in the late 90s, where the number of short bias funds by 1999 and 2000 really had dwindled to a handful. And people just got exasperated. And that was right before there was really 10 years from 99 to 09 of just fantastic returns on the short side, and 2 bear markets, of course. But I think that really it's the length of time beyond just Fed policy, although Fed policy certainly had a lot to do with it in the last 10 years.
Now, I introduced Chanos & Company. It's now a family office and advisory instead of a hedge fund firm, right? Yep. You are investing in the market, though. I'm curious how you're investing in the market right now.
Well, and we're advising clients. Look, I mean, this is I just advised a client on a put basket strategy this afternoon, and right now, what we're seeing in the universe of companies we follow is probably it's as attractive a time as it was in first half of 2021. And I've said publicly that 2021 was the most speculative market I've ever seen in my 45 years of investing. And we're getting back to that. Not quite there, but it's close. And you've seen it with things like the meme stocks again. And my God, we're starting to price SPACs again. I noticed that it's $3 billion of SPACs priced.
Does that give you agita, particularly the run-up we saw in GameStop? And yeah, I mean, SPACs are somehow trying to claw their way out of the grave.
People have always said, well, what about the Fed, per your first question? And I always said, well, give Wall Street enough time. The Fed is not the only one with a printing press. Wall Street does a pretty good job at issuing pieces of paper when people really want them.
I mean, how do you sort of navigate? And you talk about advising folks. You're advising people on a public market, public equity market, at least right now, that is at record highs, at least on the S&P and the NASDAQ. Yep. A lot of people would look at historical valuations and say, we're stretched here. What is the advice you give in that situation?
Well, since really the mid-90s, we ran our business where we were long equity markets, we were long indices, and then short our names. And I still think that makes a lot of sense. And where the stock market is going, I have no idea. I started my firm back in 1985. The Dow was 1,300. So I mean, that should tell you something about timing. But the fact of the matter is that with the exception of the far right group of companies on the bell curve, most companies underperform the stock market over time or fail. It's the NVIDIAs or the Teslas or whatever on that far right end that go up quite a lot that give you your returns. So the strategy of being long equity markets broadly and short idiosyncratic names, I still think makes a lot of sense. And then finally, insurance is really cheap right now. I mean, you know, people insure their homes, they insure their cars, they insure their loved ones. It's pretty cheap right now to insure a portfolio.
Is AI in a bubble?
I have no idea. You
lived through bubbles. You lived through.
I've gone through bubbles. I'll make one observation as it relates to AI. So if you go back and look at the U.S. economy in the immediate post-internet age, and I think we can all agree the internet changed our lives in a major way. From 1998 to 07, the U.S. economy grew at 3% real annually. From 1988 to 1997, the 10 years prior to really the advent of the internet to the public, the economy grew by 3% annually. The internet had no impact on growth. Now, it had a lot of impact on individual companies, getting back to my point, right? There were big winners and big losers, right? You know, and I suspect if AI is going to be as transformational as people think it is, and I have no idea whether it will be or not, you know, there'll be big winners and there'll be big losers.
I just want to follow up on that, though, too. And this kind of leads back to the question Scarlett started off with about the connection between macroeconomic conditions and our markets today. And there does seem to be a disconnect.
Yeah, I wouldn't disagree with that. And I think there's a much more speculative nature of this market. And we started to see it in late 2019 when commission rates got cut to zero. And retail began to come back in the market in a big way, in ways they hadn't been in. Prior to that, they'd been investing in ETFs or mutual funds or what have you. And we began to see pre-pandemic speculation in individual names really pick up. And then, of course, post-pandemic, it took off. And we're still, you can see it in option volumes and a lot of other sort of quantitative measures that the public is in the stock market in a big way. And that really then means that you have to change your risk parameters, change the size of your short bets, if you will, and be mindful of the GameStops and those kinds of things. On the other hand, generally they chase momentum and sometimes, quite frankly, silly stories. And if you want to be investing, you don't want to be doing that.
If you were looking at the AI story, and I get you can't say it's a bubble, but but it's spread out in lots of different parts, right? Utilities have been up, power has been up, you have hardware coming up, you got software, like it's like the tentacles are moving out.
Right.
How do you think about something like that? Like how do you?
Well, we look for, I mean, for one, we look for companies in our world that have gotten the benefit of an AI, kiss, but are actually going to lose because of AI. So we've been publicly short the data centers, the legacy data centers, because they literally are not designed for AI chips. They have to basically be retooled completely. And all of the infrastructure and hardware in a data center, an old one, is not compatible with the new chips. So people have bid the stocks up thinking they're AI plays. They're actually losers from AI. And it gets back to the winners and losers thing.
We mentioned SPAC companies a little bit earlier. I'm wondering if you're trading around the elections at all. What might a Donald Trump victory in November, for instance, mean for regulation? And would that, as a result, perhaps create more opportunities to be short companies because, with the regulatory heat taken off, companies can do all kinds of things and speculative fever goes up?
Yeah, I mean, it's hard to bet based unless you know who's going to win.
Yeah.
It seems like I still think it's going to be a pretty close election. And obviously there's certain areas that each party would emphasize and de-emphasize. I mean, again, some areas that we're already negative on, like solar, would probably lose under Donald Trump. But it's hard to know exactly, particularly if the polls are right, that it's still a pretty tight election.
Yeah, and of course, he's a booster for all kinds of companies, including his own SPAC. You've been very vocal about how irrational retail day traders are. How much can a charismatic influencer like Roaring Kitty, aka Deep Effing Value, and what's his actual name, Keith Gill, and an army of day traders keep this GameStop dream alive? I mean, from where you sit and looking at it, at some point it comes crashing down, does it not?
Well, it already has. I mean, so if you look at the meme
But
stock,
there's little blips here and there.
Yeah. But if you look at the meme stock class of 2021, which was GameStop, AMC, Bed Bath & Beyond, a number of others, I mean, with the exception of GameStop, they are all down 90, 95, 99%. It was disaster for retail investors, quite frankly. And so I think that it gets to my point that you don't want to be chasing this stuff if there's no fundamentals behind it. And I have no position in GameStop, but people are still valuing that company, if we're going to value a business, at 3 times its cash. And even though it's raised all this cash, it's got about $9 a share in cash right now per share. I think the stock's at 25 or 26 or 27. And so you have to believe the business has something, or there's option value to the cash, which is what people believe, that Ryan Cohen will be able to do something. That's really hard to do when you're paying $3 for $1 of cash. And again, so you're chasing the future, you're chasing the story. In bull markets, the future gets a premium. In bear markets, reality gets a discount.
Well, when we talk about that premium, particularly when it comes to GameStop and some of those meme stocks, let's talk about potentially the other side of that trade, which is sort of the short positions. We saw that in 2021 where the short interest went through the roof. We're not seeing that necessarily as aggressively this time.
The opposite.
But part of that reason is because there aren't a lot of folks like you doing this anymore. A lot of those folks got scared off. Obviously, we know what happened to Gabe Plotkin, and a little bit earlier, we were just talking about Andrew Left, who had a short position in GameStop, but even he closed that out.
Yeah, well, again, we can just look at the numbers. Overall short interest is down, as you allude to, but take a look at GameStop again, just use this example. So a week or so ago, 10 days ago, short interest was 22% of the outstanding or of the float. Today it's 11%. A, the short interest went down. B, they issued a lot of shares. Getting back to my point about issuance. So the supply increased, and now the shares are, so now it's not a short story anymore. The shorts aren't trapped. In January of 2021, I think the short interest was 140% of outstanding.
Yeah.
And now it's 11. It's a big difference.
Okay, so maybe that's not a target. Is there sort of a market, or more importantly, appetite for that sort of short seller's playbook, a playbook that you made famous. And it just doesn't seem like there are sort of new Chanoses coming around the corner in this space anymore. How do you feel about that?
I don't know. I you know, after 45 years, I don't wish that on anyone, maybe.
But there are people who like want to aspire to that, right? Like, are there players in the market?
There's some really good.
that
There's
you think
some
are
really good people on the short side out there that are doing great work.
Like
and,
who?
like the folks at Hindenburg, I'm a big fan of, and others. And you know, we never did the short activist model, but the work they're doing is I think, you know, the fundamental work, which is what I look at when I look at people's work, is really first rate. And so it's out there. And I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are trying to take advantage of investors. So we need short sellers more than ever.
We need short sellers more than ever, but the government's cracking down on all of them, right? This ongoing investigation into activist short sellers has resulted in its first charge. I believe Anson Funds and Anson Advisors
I saw that today,
were accused of hiding payments to bearish researchers.
It was a disclosure issue, really.
It was a disclosure issue, but it's something, right?
Yeah, I think that was the issue, and we were never involved with that, and that was never part of our business model. But I think that the issue that the government was worried about in the SEC and possibly justice was disclosure. Were there people funding these things that was not disclosed that should have been? I can argue that legally, but I think that was really what the issue was were there third parties involved in funding this that should have been disclosed or not?
Yeah, it goes back to that idea that there's a lot of ways to make money. Short selling is complicated, it's expensive, and it's certainly a risky way because your downside is unlimited. You shut down your hedge funds last year, yet given where we are in this market cycle, you say we're in the golden age of fraud. This might be a good time for short strategies in terms of performance. Do you see it getting a little bit easier to raise capital from institutional investors for short strategies?
It's harder.
No?
Yeah, and that's part of why the opportunity set is there. Nobody wants to do it. And so I think that's what's so interesting. And of course, you had the growth in the platform companies, the so-called pod shops. So a lot of short selling is done through those vehicles in terms of dollar value. They've certainly supplanted the long-short world in a major way. But with tighter risk models, so we see more volatility sometimes because those platform companies keep short positions small, and if they move against you a certain amount, you're out. But by the way, that works on the long side too.
But do you think, though, that long-short strategy might actually have some value at some point in time?
Oh, absolutely.
Because, I mean, we talk about this idea. I mean, you can't have a market that's all long. I mean, that doesn't work forever, does it?
I don't think so.
Okay.
And as I said, we have 40 years of almost of numbers that kind of prove that wrong.
Yeah.
In pretty much straight up market. So I think that again, as long as you're doing your work and don't focus on the short term and understand that a dollar's not worth $3.
Right.
And you shouldn't pay $3 for it. And if you can sell it for $4, that's maybe not a bad trade. I think there'll always be room.
I was having a conversation with a long-short manager, and she kind of pointed out this idea of, at least in her mind, that price transparency or price discovery was not as easy as it used to be. So that made the strategy a little bit harder. And she pinned some of that on the distortions coming out of the private markets. The idea that private markets have stolen a lot of thunder from public markets. You don't necessarily have the same balance or equilibrium in private markets, in public markets, that you had in the past.
That's an interesting theory. Yeah. I have not considered that the private markets would impact the short side in that way. I mean, I think the private markets, the growth in private markets has had a lot more to do with capital raising, particularly in the public market arena, including long short. You know, I sit on a couple of investment committees, and we've been doing nothing but redeeming hedge funds and giving it to private equity, private credit. And in my own view, I think that's not the right thing to be doing right now. I think that wherever you see a flood of money for years and years and years, it's been pretty much, you're not going to get the outsized returns that you had 10 or 20 years ago.
Jim, let's circle back to individual stocks. Why don't you like solar stocks?
I don't like solar stock. I don't like the residential solar stocks because the business model doesn't work, no matter what rates do. The concept of putting up panels on someone's roof and then leasing it from that company, if you just look at the numbers of the companies that are in that business, like Sunrun or Sonova or whatever, they bleed cash. And they use accounting constructs to tell you why it's really economic And meanwhile, they're just burning hundreds of millions of dollars per quarter, and have been for years and years and years. And I think that is just simply an accounting story.
What else don't you like? You laugh. I mean, like, it's interesting to get your take, because solar stocks have been on a tear. Like,
Yes, well, the last couple of weeks.
Yeah.
Yeah, they were actually hitting new lows just last month. And so they bounced because of the view on rates. We're not going to talk about the Tesla shareholder vote?
Well,
Yeah,
actually,
yeah.
well, let's hear it. Here, she
I was setting you up. You're taking away my thunder. I asked you that.
I was waiting for
Scarlett's
someone
gonna
to
go
come up
Tesla.
behind me. We don't like the data centers and haven't. We've been public on that for a long time. I'm puzzled by the number of restaurants that are trading at absolutely insane valuations in an industry that, ultimately is not a secular growth business. You can find stocks at 50 times cash flow and 100 times earnings. And there's lots of companies that are kind of mundane that have been bought by growth managers where the returns on capital are low, that are trading at 50, 60, 70, 80 times earnings. You can find them. There are a lot of them. And so it's a pretty target-rich environment right now if you're doing fundamental work.
Okay, now
I'm sorry, did he answer the question on Tesla?
No,
the question he asked himself.
Yeah. Well, Tesla is holding its annual general meeting tomorrow, and you were famously short Tesla at a time when it basically defied gravity. We know that shareholders are going to be voting on Elon Musk's $56 billion pay package, not from this year, not from last year, but from a couple of years ago.
Yep.
What is that emblematic of? What does that tell you?
Well, first of all, it might shock some of your viewers, but I tweeted out a week ago, I actually think that people should vote for the package.
Really?
I think, even though I'm a bear on Tesla, I think a deal is a deal, even if it's a bad deal. And they agreed to it. Now, the judge even if they voted in again, that doesn't mean it may happen. It may not obviate the ruling. But I do think a deal is a deal, and that if you voted for it, that he should get it. Having said that, the value of the package is in excess of all the retained earnings of the company's ever made, even post-package. And the one thing I pointed out today, the one thing I've been scratching my head on and going back and looking at this package from 2018 was that the deal was contingent on hitting certain numbers and the stock price hitting certain values. But what they didn't do was make each tranche the new equity award that he got for doing that, the strike price of that option at the stock price at that moment. All of the equity for all of the tranches was set at the original price, which was $23, adjusted for the split. So that means there's really no clawback provision, and basically it means if the stock goes up a lot and then goes down a lot, he still wins. The shareholders don't necessarily win. And in fact, I think the stock price is below where he earned the last tranche already. So it's a little bit like a hedge fund manager saying, okay, well, I was up 40% at mid-year and then gave it all back in the second half of the year, but you should compensate me on the fact that, I was up a lot at one point. And so that's the one aspect of the package I think shareholders should really, be kind of kicking themselves on. I think that the tranches should have been set at each point at which the stock price had to go to. But having said that, I think he should get it. I'm not a big fan of Elon. There's no surprise of that. But a deal is a deal.
All right, everybody. You have been listening to our TV colleagues talking there with Jim Chanos on Bloomberg Television. You can catch the full conversation with Jim Chanos on Bloomberg Talks podcast. Download it now, Bloomberg.com or wherever you get your podcasts. Talking Elon Musk, which in the Musk universe is Tesla, but it's also SpaceX.
We're talking about SpaceX, talking about Boeing, Blue Origin, Axiom Space. Those are just a handful of the companies that operate in the space economy. The World Economic Forum estimates that the space economy will be worth $1.8 trillion by 2035. Another company in that space is Spire Global. Spire says it designs, builds, and operates the world's largest multi-purpose satellite constellation. It's a publicly traded microcap, valuation just about $250 million. The stock up about 24% so far this year. A big part of that after the company in March announced a partnership with NVIDIA to advance AI-driven weather prediction. We've got back with us the founder and CEO, Peter Platzer. He joins us from Geneva. Peter, good to have you with us. We're going to get to the NVIDIA partnership in just a minute, but you operate in the maritime, weather, climate, aviation, and government sectors. Explain what exactly your technology does and the services that you offer clients.
Thanks so much, Tim and Carol. It's a pleasure to be back here. So for the last 12 years, Spire has been delivering data and analytics from space to create a better future on Earth. If you are looking for safer, cheaper flights, our products can help with that. If you want your business to be better prepared for weather, including extreme weather, our services can help you with that. If you're looking for a more reliable, faster supply chain with a lower carbon footprint, we can help with that. Basically, we track activities all across the world, be that ships, planes, or the weather, to create a more sustainable, prosperous, safer future for all of Earth.
So what's the CapEx hardware that you guys actually have to deal with? Or is it mostly data that you're dealing with?
So we are dealing mostly with data. We have, because we are fully integrated, an annual CapEx cost of like $5 to $7 million that support and quasi unlimited amount of revenue. I mean, the company is way over 100 million in revenue and has been growing compound annual growth rate since 2017 over 100%. But we are incredibly efficient, and we collect the data and then we sell it many, many times, just like any subscription company. And while the entry point originally is incredibly high, getting space to work is difficult and tricky. Once you have cracked that nut, which Spire has with over 600 years of space heritage, for us, the maintenance of keeping that constellation up and up to date and at the cutting edge of technology is just $5 to $7 million a year.
Speaking of keeping that constellation up there, I want to talk a little bit about deorbiting and how you were able to address the deorbiting setback and how you've insulated yourself from those risks going forward. So explain what exactly happened.
Right, so the sun has an activity cycle that is between 7 and 11 years. And when it gets the sun more active, it kind of like blows up the Earth's atmosphere and it reaches higher. And that creates increased friction. And as it creates increased frictions with spacecraft, all of them may deorbit a little bit sooner. And as spacecraft get towards the end of their life, for us, that's, like 4, 5, 6 years, small changes can make a big impact. And while we have a very regular replenishment schedule, there was a bit of a mismatch. Now, our constellation is software defined, so that means that we can change what it does, which is exactly what we did. We increased some software capabilities to lower the data latency. We added to our ground station network to create more robustness there. So you adapt to it because as a fully integrated company, we have the ability to do that. And it's one of the huge advantages that Spire has.
Where's your biggest growth?
So there are fundamental trends that we have been betting on for the whole time of the existence of the company, in particular climate change and global security. And they continue to be in 100% operation, driving demand for our products and services forward. But in particular, recently, we've seen some of the supporting trends that we indicated many, many years ago, the growth of the space sector, the digitalization of the global economy, with data being the oil of the 21st century, and AI and machine learning further accelerating our growth. You mentioned it earlier, we have seen contract sizes dramatically increase as we are adding AI to mine our data for increased capabilities. I mean, we are flying NVIDIA Jetson processors for a number of years now because it gets us to insights faster from the massive amount of raw data that we collect.
This is a partnership with NVIDIA that you announced just back in March. The company announced a partnership with NVIDIA to advance artificial intelligence-driven weather prediction. Any more deals like this on the horizon?
Well, as a public company, I would wish to tell you everything that is on the horizon. What I can tell you is that we couldn't be more excited about the demand side that we are seeing, given those trends and the capabilities that Spire has. For better or worse, the threats from a global security perspective, as well as the impact that weather is having on communities, countries, corporations, all across the world, is not diminishing anytime soon. And if anything, we see it consistently and continuously increase. So we love working with companies like an Aurora Tech or a GHG, which is using our capabilities and their capabilities and payloads to predict wildfires and detect greenhouse gas emissions. Companies like Hubble that connect space, from our technology and their technology to Bluetooth devices and driving an IoT revolution to help on everything from transportation to agriculture and much more. So where we see the demand coming from those trends, we see to continue to accelerate and drive the growth of the company.
But Peter, how much in terms of I'm trying to get an idea of, just for our audience, the specific industries. Like weather is obviously weather indicators, right? It's a big part of what you guys do, ship and airline signals. So I'm just trying to understand exactly where the growth is in terms of demand for what you guys provide.
So when you think about the global supply chain, right? There's many players there that are tackling that problem. You have anything from harbors where there are 5 to 10,000 harbors, like the harbor of Rotterdam, one of the largest harbors in the world, a customer of Spire, that is using our data to improve both the efficiency of its operation as well as its greenhouse gas footprint. Then you have the actual charter and shipping companies, which want to optimize their route, and in particularly when they have sensitive cargo, like, for example, a temperature-sensitive cargo or perishable cargo, to optimize the spend that they have on the cargo, with fuel being a massive portion of their balance sheet. And so Spire's both tracking and weather helps them reduce that. And then you have the distribution on land, where, again, weather is making a massive impact. So there already you have tens of thousands of customers that are all operating the supply chain on a global basis that are looking for Spire products. Then you have the financial services companies.
That's what I
think about insurance companies.
That's what I want to know. How much of your business is to the financial area?
So it is not an overwhelming amount, Carol, to be honest, right? It is, we have literally, dozens and hundreds of use cases, but we do have a good portion of our business in the financial services industry, but it is not a dominant industry, I have to tell you, for our customer base.
How much of your business comes from governments, including the European Space Agency and the United States?
About 45%, so less than half of our business is from the government side.
Okay.
And more than half, about 55%, is commercial customers.
You mentioned balance sheet, so I'm curious about your balance sheet, because you announced a registered direct offering of $30 million back in March. How's your cash balance right now? Is that enough?
It just got about 30 seconds.
We have an extremely strong balance sheet, not least because of the fundraising that we did in the first part of the year. That makes us feel very, very comfortable, given that we have re-announced that free cash flow positive is in the summer of this year. We've already been adjusted EBITDA positive and cash flow from operations positive end of last year. So just at the verge of producing our own cash, we feel very, very strong about our balance sheet.
All right, great stuff. So glad we could get some time with you today. Peter Platzer, thank you, the founder and CEO of Spire Global, joining us from Geneva on this busy Fed Wednesday.
Fed Wednesday, Space Wednesday.
Yeah.
Bond market Wednesday, equity market Wednesday.
On to Thursday we go.
Oh, yeah, we're there.
All right, guys, have a good and safe evening. Thanks for being with us. I'm Carol Master along with Tim Stanovic, and this is Bloomberg Business Week. Balance of Power now.
Politics to the world of business. This is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Joe Matthew, I'm Kaylee Lyons.
The Federal Reserve dials back its forecast to just one interest rate cut this year, only hours after monthly CPI data show cooling inflation. We'll have details from Washington and insights from Jared Bernstein, chair of the White House Council of Economic Advisors.
President Biden just landing in Italy for a meeting of the G7 nations. We'll discuss his agenda with Congresswoman Haley Stevens of Michigan and also ask her about what just happened on the House floor. Republicans voting to hold Attorney General Merrick Garland in contempt of Congress.
And our conversation this hour with Steve Ballmer, the former Microsoft CEO, joins us on artificial intelligence and his mission to counter misinformation with something called USA Facts. Thanks for joining us on Bloomberg TV and radio following the unanimous decision from the FOMC to not change interest rates. Fed Chair Jay Powell had this to say when asked why Americans are unhappy with the economy.
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace.
Joining us now, Jared Bernstein, chair of the White House Council of Economic Advisors from the North Lawn of the White House. Jared, welcome back. It's good to see you on the program. I don't know if this is Celebration Day at the White House. I see the statement from the president says prices are still too high. But to what extent are you allowed to acknowledge the ground that's been covered here, the progress that's been made?
Well, both things are true. You heard Chair Powell talk about the strength of the economy, but I think we've been out here long enough, you, me, and Kaylee, talking about exactly that. We know we have a job market with an unemployment rate that's been 4% or below for 2.5 years, and we know that prices are too high. The question is, what kind of progress are we making? And when we get a month of May with 272,000 jobs, which is the last time I was out here talking to you two, and then followed by an inflation report that was 0 for the month, obviously that's progress on the right track. We have to continue aggressively pushing down costs where we can. Healthcare, childcare, housing, junk fees, while doing all we can to maintain the tightness of the labor market. We are making progress, moving in the right direction, not there yet.
Well, Jared, one of the areas where we're still seeing stickiness is shelter. This is actually something that Chairman Powell was